Hey option traders, for today's trade we are looking at an option play in S&P 500 ETF SPY. With the market in correction, many analysts have set a price target of 3,300 for the S&P. Today the index is currently trading at around 3,600. We are going to look at a butterfly trade with put options centered at that 3,300 level using the Spider S&P 500 ETF. A butterfly with put options consists of a few key components. Remember that with options there are two types. There are calls and there are puts. With both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy long or sell short. The butterfly trade is created when an investor sells two puts at a given strike price, then buys one lower strike put and one higher strike put relative to the two short puts. The lower strike put is going to be equal distance from the short puts as the higher strike put. A butterfly can also be set up using call options. Each option in the setup will have the same underlying stock, the same expiration date, but a different strike price, except for the two short puts, which will have the same strike price. So typically, the two short strikes will be at the money, meaning as close to the current underlying stock price as possible. As for the other two strikes, one will be in the money and the other will be out of the money. These, however, can be adjusted to best suit the needs of the trade. With a butterfly put spread, you will pay a debit or a premium for the trade to put it on. Typically, the overall directional assumption with this trade is neutral. We think the underlying stock or ETF will trade in a tight range compared to its current price. These spreads are also best placed in a high volatility environment. Depending on the option, you could have a number of different expiration dates and strike prices to choose from. This, incidentally, is one of the many strengths of options. Options provide the investor with choices, and investors can analyze a variety of criteria to determine which best fit the needs of their portfolio. So say we assume that XYZ stock will fall to $45 a share by the expiration date of your trade. You'd enter a butterfly with two short puts with a 45 strike while buying a lower strike put and a higher strike put around this point. Maybe you choose a lower strike of 40, 5 points below the short strike, and a higher strike of 50, 5 points above the short strike. The spread costs you a total debit of $1. There are technically two spreads here in this trade. The first is between a long 40 put and a short 45 put, and the second is between a short 45 put and a long 50 put. The maximum profit is achieved if the underlying price of the stock is the same as the two short puts at the expiration. Max profit is equal to the higher strike minus the strike of the sold put minus the premium paid. The maximum loss of the trade is limited to the initial premiums and commissions paid. Since achieving maximum profit on a butterfly is highly unlikely, the profit target on this position is generally lower. A reasonable profit target to aim for on a long butterfly is 25% to 50% of the maximum profit. So now that you have a better idea of how to set up a butterfly spread using put options, let's take a look at my trading platform and set up a real-life trade using SPY.
So to set up this trade, first make sure you're looking at SPY, which is the ticker symbol for the ETF. Select butterfly as your spread type here. If you're using Thinkorswim, it'll make it easier to set this up. As for our strike prices, we're going to select this one here, and we're going to use this side of the screen for puts. And we want this middle 330 strike, and then we can adjust these down below. So to summarize, we are looking to buy one November 18th 310 put, sell two November 18th 330 puts, and buy one November 18th 350 put.
We're looking to buy one November 18th put with a 310 strike, sell two November 18th puts with a 330 strike, and buy one November 18th put with a 350 strike. The total cost of this trade is $225, and that is the maximum potential loss as well. The maximum potential gain is $1,775, which is calculated by taking the difference in strike prices minus the premium paid. If SPY doesn't get to 330, the investor only loses a little, but you have the potential for a large payoff if it does hit 330 in about 5 weeks' time. Always remember that options are complex and investors can lose 100% or more of their investment. And be sure to check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.